Let's get to our closing bell exchange. Joining us, Oliver Pursche from Bruderman Brothers, Stephen Guilfoyle, contributor at Real Money, Rick Santelli at the CME Group in Chicago. Sarge, you know, when you look at these Made in America events and you're reminded of some of the trade tactics, you're also reminded of the fact that the market has climbed this wall of worry pretty well. And we're back positive on the session, coming off of 3 straight weeks of gains. How do you trade around some of these trade headlines, whether they still come up or not?
Well, it becomes much easier during earnings season to trade the headlines. Like this week, you have defense names coming at us. All 5 of the majors are coming at us this week. You have a lot of the semiconductor names. You have a lot of the energy names. So but you have to base what you see, not so much on the data, because the data is historical, but you have to base what you hear in the call. You have to pay attention. You have to read the calls or listen to the calls, and you have to judge where you want to be based on how these CEOs feel about tax cuts, how they feel they themselves can traverse the tariff problems, and I'm generally pretty positive. As most people know, I do believe that President Trump can win most of these trade battles. I do believe that this is suppressing the market. I don't believe that the market is faring so well. I believe the market is actually being suppressed. Certain areas are down year to date, such as staples, industrials, materials. So I believe we're actually sitting on a volcano as far as the market goes. We get positive headlines here, and you're going to wish you bought shares on these dips.
Rick, so let's talk about the yield picture today. Clearly quite a big move higher in the 10-year note. Is that down to positive expectations for US GDP growth, or because yields elsewhere, like in Japan, are rising?
You know, I think it's a combination of everything. It's no coincidence that this Friday we get our first look at second quarter GDP, and it could be a whopper. It could have a 5 handle. Now, I'm not saying it will, but, you know, 4%, that's not bad, and most are calling for a 4% handle. 10s and 30s today were up 7 basis points, so 10s to 2s steepened by 2 or 3 basis points. It's now about 8 basis points off its flattest, which was 24 about a week ago. I think the Japanese story is a story that's going to happen, and it isn't because the Bank of Japan is volunteering to remove some of the stimulus. The more that the U.S. central bank does, the better the U.S. economy does. The more Mario Draghi in Europe hint that they need to move and remove accommodation as well. It's just going to be a force of nature, and the Bank of Japan, I think, has very few choices but to try to get their less accommodation ducks in a row. And it's going to be an overwhelmingly large job for them, considering all the areas of ownership they have and some of the distortions. You think we have distortions here, Wilf? You know, not only are they managing rates, they're trying to manage the entire yield curve. The only bright spot I see is ownership of the securities in many ways is by citizens of Japan. That will help mitigate some of the issues. The July 31st, August 1st is their policy meeting, so there's a lot of big things coming up in the windshield over the next 2 weeks.
Yeah, they've got a tricky tightrope there. Oliver, if you look at the group's performance within the market today, I mean, financials are on top and staples are on bottom. It's really all related to that move in yields.
It is, and it points to a very interesting phenomenon, going back to the trade war component. You know, it's all about, in President Trump's mind, trade deficits. But the missing component to that is that trade deficits come with account surpluses and a lot of net foreign investment. If he wins the trade war, and win in quotations, that means you're going to see less net foreign investment and less net capital. And that's problematic for markets. And that's why you're seeing things like financials move so much, because interest rates are coming higher and they will benefit from this. But consumer staples lag because they're going to be impacted by some of the net foreign investment decreases.
Sarge, is the chance to buy banks been and gone? They rallied last week, they're rallying today, or is still a buy?
Well, what you can do if you think you missed this rally, and I do this all the time, is you figure out where you wanted to buy them, where you missed it, and you sell the puts if the premium is there. So basically, pick any stock you want. If, let's say it's trading at 110, you wanted to buy it at 107, you can sell a 107 put, go out a couple months, maybe towards the next earnings release. And if you can sell it for $1.25, well, even if you get run over, you bought it at 105.75. So I try to explain this to my readers all the time. You can still get in on the names even when you miss them. You just might not have an equity stake.
Yeah, people wondering about tech, that same question, Oliver. I mean, it's up again today, best
look,
heading into earnings.
You've got 170 of the S&P constituents reporting this week. So you've got GDP number, which is going to come out, and that's likely to be very strong. So in the very short term, yes, these high momentum sectors are probably going to continue to move, and it's unlikely that you're going to see any geopolitical news that is going to derail that, because right now markets are shrugging off the trade war. They're shrugging off all this stuff, and they have for some time. So yes, I agree. I think there's still room to go in the short term, but on a long-term basis, you've got to look at so many things and be a little bit cautious.
Do you agree with that, Sarge? The whole thing was that people were buying these high momentum, high growing names because we were in a slow growth kind of world. Rick Santelli's talking about a 5 handle on GDP.
I think we could see a 4.7 or a 4.8. I don't think Rick's too far off.
That's not a slow growth world anymore.
No, and I don't think we've really shrugged off the trade wars, because why is the Russell outperforming so much? Why are the sectors I just named before, the materials, the industrials, why have they struggled so much? We have actually started to price in the result, whatever it might be, of a trade war.
Yeah, but I mean, I think in a normal environment, if you had this type of rhetoric and it wasn't coming from...
Do you think we'll ever have a normal environment
you would have had a 10 or 15% correction, not a 5 or 6% correction. So I think it's been a muted reaction overall. But again, to go back, I think we're saying the same thing in the sense that in the short term, things are very positive, and you want to be long equities. You don't want to be out of the asset class and get overly nervous because of the noise that's out there.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.